AI chip stocks just got crushed. Intel plunged nearly 7%. Qualcomm crashed more than 10%. But the real danger isn't today's sell-off. It's that Wall Street may finally be starting to doubt the AI boom itself. Hey everyone, on Deep Dive Stock Earnings. Here, we don't just look at price moves, we break down the logic and trends behind them. If you want to truly understand how the market works, make sure to like and subscribe. Let's get right into it. One of the biggest changes in the market this morning is that AI chip stocks suddenly started showing real weakness. Intel fell 6.8%, Qualcomm plunged 11%, and Micron dropped more than 3%, while the entire semiconductor sector came under heavy pressure overnight. This is actually the first major coordinated sell-off we've seen in the AI trade over the past year, because for the last 12 months, AI has been the hottest theme in the entire market. Nvidia kept making new highs, money kept flooding into semiconductors, and investors started assuming that anything connected to AI would just keep going up. At some point, a lot of traders stopped caring about valuation altogether and only focused on chasing momentum. But last night, sentiment finally started to shift. More investors are realizing that when the entire market crowds into the same trade, the risks get amplified fast. A lot of people think this is just a normal pullback, but what Wall Street is really worried about isn't how much these stocks fell overnight. It's that AI chip valuations may already be overeating. Many of these stocks have been rising much faster than their actual earnings growth, and when everybody starts believing that AI can only go up, that's usually when risk quietly starts building underneath the surface. Ironically, the most dangerous phase of a market is often when optimism is at its highest. The entire AI market is now entering a very critical stage. Up until now, the core market narrative has been simple: AI is going to explode in the future. So tech companies are aggressively buying chips, expanding data centers, and massively increasing AI spending. That expectation pushed AI chip valuations higher and higher. Many of these companies kept rallying even when earnings growth wasn't fully keeping up, because investors believed AI demand would continue expanding at an unlimited pace for years. But the problem is, no industry can maintain peak growth forever, and now the market is starting to wonder whether AI demand growth may already be approaching a temporary ceiling. If growth begins slowing even slightly, these high valuations could quickly become the sector's biggest weakness. Wall Street is starting to ask a very different question now. Is AI actually generating real profits, or is the market simply pulling future growth forward too early? Because if earnings growth can eventually justify these valuations, many AI stocks may already be priced for the most optimistic scenario possible. And once investors realize reality may not move as fast as expectations, sentiment can reverse very quickly. Intel was really just the treater last night. The bigger issue is that the market is starting to reevaluate the entire AI chip industry. Right now, the defining characteristic of AI is massive spending. Tech companies are continuously buying chips, building data centers, expanding AI training capacity, and investing heavily in servers and infrastructure. The entire industry is running on enormous capital expenditures, but the problem is becoming more obvious. AI investment costs are incredibly high. While many AI business models are still in very early stages, some companies are committing tens of billions of dollars into AI before proving they even have a stable long-term profit model. And now investors are starting to worry that if the economy weakens, corporations may eventually slow down their AI spending. If AI capital spending starts cooling off in the future, then the entire valuation model behind AI chip stocks could get repriced. That's exactly why Wall Street has been getting more cautious on the sector recently. Because what scares the market most isn't slower growth by itself, is slower growth combined with extreme valuations. Another major shift happening right now is capital rotation. Over the past year, investors aggressively chased AI chip stocks, but recently, more money has started flowing into AI software, cybersecurity, enterprise AI services, and AI infrastructure companies instead. Stocks like Datadog, Palantir Technologies, and CrowdStrike have recently shown much stronger momentum than many semiconductor names. That's because investors are beginning to realize that the biggest long-term winners may not just be GPU manufacturers. It could be the entire AI ecosystem. As AI moves closer to real-world commercialization, companies capable of generating consistent cash flow are becoming more important than simply having an AI story. The market is slowly shifting from who sounds the most exciting to who can actually generate sustainable profits. The AI trade may not be over, but the direction of AI profits is starting to change. In the past, investors chase companies that simply look the most connected to AI, but going forward, the market may focus much more on which companies can consistently monetize AI over the long term. Commercial execution could soon matter more than hype. A lot of retail investors are still extremely optimistic right now because over the past year, AI has been one of the most profitable trades in the market, and the non-stop rally has created a dangerous emotion, FOMO, the fear of missing out. But historically, every major hype cycle follows the same pattern. First, nobody believes it, then the market explodes higher, and eventually, the sector enters a high volatility phase. AI may already be entering the third stage now, because when everyone starts believing that prices can only go up, risk usually begins building much faster underneath the surface, and the more euphoric sentiment becomes, the more violent future volatility can eventually get. Smart money usually starts adjusting positions when market excitement reaches its peak, because the most dangerous part of a bull market often isn't after a crash. It's when people become convinced that a crash can't happen anymore. Once optimism turns into consensus, risk itself starts getting underestimated. Another huge issue for the market right now is interest rates. AI companies are growing fast, but their valuations are already extremely high, and higher interest rates put significant pressure on growth stock valuations. That means if growth slows even slightly, these expensive AI stocks could experience very sharp corrections. That's one reason why volatility inside the AI sector has been increasing lately. The market is now entering a high expectation, high risk phase. The old environment where simply mentioning AI could send a stock soaring is slowly changing, especially with the Federal Reserve keeping rates elevated. Investors are becoming much less tolerant of overpriced growth stocks. The AI market is no longer in that easy phase we saw last year where almost everything kept going up. Going forward, investors will become far more selective. Real earnings power, not just AI narratives, will determine who survives. Companies with hype but no profit foundation could see much bigger swings ahead. What's interesting is that even though AI chip stocks are pulling back, actual AI demand hasn't disappeared at all. Global tech companies are still investing aggressively in AI. Data centers are still expanding. GPU demand remains strong. Enterprise AI adoption is still accelerating. That suggests the long-term AI trend may still be very real, but now the market is starting to separate true long-term winners from companies that were simply pushed higher by hype. As the AI industry matures, investors may care less about who talks the loudest and more about who can consistently generate profits. The real competitive phase of AI may actually just be beginning. The biggest change in AI going forward may be real separation inside the sector. Not every AI company is going to keep rising forever. The companies that survive long-term will probably be the ones with real profitability and sustainable business models. And the biggest winners may not be the hottest names. They may be the most financially disciplined ones. So the most important story last night wasn't how much Intel fell. It's that Wall Street may be starting to reprise the entire AI sector. The old narrative was simple: AI will keep growing, chip demand will keep exploding, and AI stocks will keep rising. But now the market is becoming more realistic. Investors are starting to reevaluate which companies can truly sustain profits and which stocks may already be overvalued. And this kind of repricing is often one of the biggest signals that a market is entering a new phase. Because once the market shifts from storytelling to profitability, the entire logic behind the AI rally starts changing completely. In the future, the market may reward real earnings power far more than pure excitement. The AI rally may not be over, but going forward, the market probably won't reward companies simply for being associated with AI anymore. It will reward the companies that can consistently generate real profits. Thanks for watching. If you found this video helpful, make sure to like and subscribe. Do you think AI chip stocks are just going through a short-term pullback, or is the entire AI trade entering a completely new phase? Let me know your thoughts in the comments below. I'll see you in the next video.